Welcome to this episode of Market Shares. I'm your host, Tony Blodgett, and today we're just going to talk a little bit about the market, the economy, what's going on in the world of interest rates and so on and so forth. So last week was a lot of news came out. We had CPI that came out on June 13th. That was May's CPI number. We had the Fed had their meeting, and then they spoke the following day. And then we've had some employment numbers come out and just all sorts of information. And I'll be honest with you, it's kind of a mixed bag. But as it relates specifically to mortgage interest rates, we have seen rates improve actually fairly significantly over the last month or so, but definitely not improving like we thought that they would, starting with that May 10th CPI number that just did not give us the great news that we wanted. And if you remember, the reason for that with May's CPI was predominantly energy prices, right? We had OPEC, slowed their production of oil. And as a result, we saw prices go up, and that was kind of unexpected. And then shelter costs just have not come down as quickly as what we anticipated, although they are improving. And then even with this month's CPI that came out on June 13th, the headline number was only up 0.1%, which did bring the year over year number down quite a bit. We were at 4%, coming down from 4.9. But if you remember, it wasn't long ago that CPI was up, inflation was up at 9%. So we've definitely come down significantly. But I'm going to talk about what the Fed said here in a minute, and you're going to see why even having a number of 0.1, I don't know if that's going to get us to where the Fed wants us to ultimately be. But CPI, 4% year over year. And this time it wasn't energy prices that kept us from seeing a bigger improvement. It was car prices, which was kind of surprising. At least I thought. I thought that the days of higher car prices were behind us, and maybe it is. They use a report from J.D. Power, which can tend to be a little bit of a lagging indicator. From what it sounds like, if you look at Car Gurus, or if you look at Manheim, which is an auction site that pushes through a lot of cars to dealerships and etc. Those numbers do look like they're coming down. So maybe the information that they were relying on for CPI was just some old data, and we'll see this come down. But nonetheless, car prices and insurance prices really were up month over month, and as a result, it kept these inflation numbers from looking better than what we expected. So at the end of the day, CPI was better, but not enough to significantly move the market. And again, I'm going to stick to what I've been saying. I think as summer goes on here, we're going to continue to see inflation come down. But now, let's talk about what the Fed said. So the very next day, I think it was on the 14th, the Fed spoke, and they did not increase the Fed funds rate. So that's good news, I think. However, they did mention that there was 9 of the Fed members that were pushing for an interest rate hike, and that are recommending at least 1, if not 2 more interest rate hikes through the end of the year. Now, most people think this is craziness, given the fact that we continue to see signs of better inflation. But the Fed seems to be really set on getting core inflation, the PCE core inflation, so the personal consumption expenditure, slightly different than the CPI and really the Fed's favorite measure of inflation, but getting that core inflation down to 2%. Right now it's at, I believe it's at 4.7. I'll look at my notes. But the core PCE, is at 4.7. They were anticipating that by the end of the year, it would be at 3.6, although they just revised that in this meeting they had last week, and they now are anticipating PCE at the end of the year to be at 3.9. So still pretty stubborn on core PCE. And the Fed makes it sound like they're going to continue with their tightening policy until we get to 2%. So it looks like right now, the Fed funds rate 5 to 5.25, widely anticipated that we're 5.5 to 5.75 now by the end of the year, with a number of Fed members wanting to continue to increase the interest rates. Now, keep in mind, these interest rates do not directly impact mortgage rates. We've talked about this. However, they do drive up other interest rates like car loans, your credit cards, things of that nature. All consumer loans, for the most part, are tied to these overnight Fed funds rate. The indexes are tied to that. And as a result, you see higher interest rates across the board. One thing that this is also leading to is the highest level of corporate bankruptcies that we've seen since 2010. So that's, there are implications. There are negative implications to the Feds continuing to raise interest rates. We know they're trying to fight inflation, which is coming down, although stubborn, I will admit, but it is coming down. But yet there's other parts of the economy that are being hurt by this. But you know what? It seems the Fed just doesn't care. They're going to keep tightening until something significant breaks. And I guess we'll see, if and when that happens. Now, in the meantime, we've also continued to see initial jobless claims up again. I think it was 262,000 jobless claims 2 weeks in a row. And now we've seen 6 months of increased jobless claims, really since the beginning of 2022. And if you remember, the Fed said that they're going to keep raising rates until we see the job market soften. And it definitely seems like we're seeing signs of the job market softening. So we see the job market softening. We see inflation coming down, but yet the Fed still hell-bent, if you will, on getting that core PCE to 2%. Now, we'll have to see if that happens. Let's talk about what it would take, though, for that to happen. In order for the core number to be at 2% year over year, that means the monthly reading needs to be less or at 0.16% each month, okay? Or less for the year over year number to be 2%. We have not seen a reading under 0.16 since July of 2022. It was 0.08%. Every other monthly reading since then has been a read over the 0.166%. So getting to this 2% number, this magical number that the Fed wants us to be at, you guys, it's more difficult than it sounds. And we're going to have to probably go through a lot of pain before we get there. Now, the good news is, for those of us in mortgage and real estate, is that pain in most cases shows up in a recession. Not that that's good news for anybody, but a recession will typically bring down interest rates, and the housing market does quite well in most recessions. So I think for those of us in the housing market, there's still going to be some pain to get there because mortgage rates are so high. But eventually, this will drive down rates if, in fact, the Feds put us into a recession, which seems to be what they're planning to do. So like I mentioned, 6-month initial jobless claims for the last 6 months have been up. This is interesting. We talk about kind of some mixed information coming through on some of these stats, and one of them is motor vehicle heavy trucks. Sales are way up, right? The indicators are that there's a lot more heavy machinery, heavy trucks being sold. But on the other side of that is cardboard boxes are at the lowest level that we've seen really since the Great Depression. So I don't know what that means. Either Amazon's got a lot better at getting people to have all their deliveries on the same day and cutting down on boxes, or people are buying less stuff in cardboard boxes. Maybe people are moving less right now as a result of the higher interest rates. I don't know, but I thought it was interesting, just some of these mixed messages we're getting in the market that, heavy trucks way up, but which would lead you to believe that, economy is good, but then cardboard box sales way down. Interesting stats. Here's another one that's way up is home purchases with cash. So what that tells us is that there is a heavy demand by investors who have cash to purchase homes. Now, we're definitely seeing homes gobbled up by regular consumers as well, but interest rates being a lot higher has got people on the sidelines waiting potentially for interest rates to come down. But investors who have cash are at one of the highest levels that we've ever seen. So good news for the housing market, and really shows that the investors that have the cash are ready to spend it on housing. Let's see. GDP has recovered. So if you remember when we first talked about the fact that we might be in a recession, everyone was using the idea that we had 2 negative quarters of GDP last year. And they said, hey, that's a sure sign of a recession. That's always been what is considered a recession. Now, since then, GDP has recovered, but it's stalled out at about 1%. So not really a great recovery. Definitely not negative, but not a good sign either. So I would say that's in the category of, not a super strong economy right now, with GDP basically stalling out at 1%, at least for now. I mentioned corporate bankruptcies, highest since 2010. That is definitely an impact of the Fed continuing to raise rates. I've spoke about this before on the podcast, that we are a country that can't survive very long with these highly elevated rates because there's a lot of corporate debt out there. And I think what you're starting to see is corporations not being able to manage the expense of all of their corporate debt. You layer on top of that a little slowdown in consumer spending, so on and so forth, and you couple those things together, and we start seeing record numbers of corporate defaults, corporate bankruptcies. So that's interesting. U.S. money market funds are as high as they've ever been. This is not surprising. If you have any money, just extra cash in savings, which we're going to talk about in a second, most people don't. But if you do, and it's sitting in your savings account, I highly encourage you to move that over into a money market account, because some of them are paying as high as 5%. I talked to someone, this is anecdotal, but over the weekend, a friend of mine said he was getting over 5%, like 5.25% in a money market fund at his bank. That seems on the high side, definitely seeing things in the mid to upper 4s, and you're not going to typically get that out of a normal savings account. So no surprise to me that we're seeing money market funds with a lot of cash in them. Now, what we're not seeing is savings. Any of the savings that were built up from COVID and all the stimulus and people staying home and socking away their money, you guys, unfortunately, that is gone. The U.S. average consumer has no money in savings. Savings rates are super low. But the fact that we see so much money in money market funds tells us that if we see a marketed improvement in the stock market, there's a lot of money that's over in these money market accounts that's really investment dollars that could be pushed in and fuel a rally in the stock market. Now, also interestingly enough, I don't have the stats written down on this, but I was listening to a podcast the other day talking about how the majority of the gains that we see right now in the U.S. stock market are just the top 5 stocks. I don't know them off the top of my head, but it's Google, it's Microsoft, it's Tesla. The big 5 tech companies are really driving the majority of the gains that we see in the stock market, and the rest of the stock market is really lagging. But what's interesting about the rest of the stock market is that because it's lagging, it's getting to a place where the values of a lot of these stocks are really good because of the ratio that they're trading at to their actual earnings. So what you've seen here, it's kind of an interesting phenomenon, but you've seen the overall stock market looks like it's doing okay because it's being propped up by 5 to 10 top stocks, while the rest of the stock market has been losing value, but getting to a point where these stocks are actually becoming a good investment because of their earnings versus the current stock price. So what that means is we could have a bottom, if you will, in the stock market without it ever feeling like we hit bottom, because these couple big mega stocks that are still performing well make it feel like the stock market hasn't crashed when the bulk of the stocks have gone down significantly and are now a pretty good value and might be worth investing in. So that's what I mean, you guys. We have like this mixed bag of information. It's a very difficult market to really call what's going to happen. But let me try to just summarize it for you here the best that I can. Here's what I think. Interest rates continue to improve, albeit a lot slower than what we were hoping. The Feds are going to probably raise rates 1 or 2 more times by the end of the year. Keep in mind, that does not necessarily mean bad things for mortgage interest rates, because what they're doing is they're continuing to fight inflation, and inflation is the arch enemy of bonds. And so we want bonds to do better. That's what brings down mortgage rates. So lower mortgage rates as we go along, potentially higher Fed funds rate, so higher interest rates on other consumer goods, cars, credit cards, things of that nature. And the stock market, I feel like, is probably at a place where it could start to recover. Why? Because a lot of the stock market has not been doing as good as it looks like it might have been doing, because it was propped up by the top 5, lots of value in these stocks, and lots of money parked in money market accounts that could come over and help fuel that rally. So I don't think it's time to get into the stock market yet, but I think that we may be getting close, and we should continue to watch for signs of that while interest rates continue to improve, and we'll see what the Fed does, and let's see how far they have to go to get their magical 2 number and what might break on the way there. Time will tell. But until next time, you guys, thanks for your time and attention on Market Shares. Please share this podcast if you get value from it with your friends and colleagues in the mortgage and real estate industry. And of course, like and subscribe. And I will see you next Friday, as we always drop episodes Friday morning right here on Market Shares. Take care.